Benjamin Franklin once said that nothing is certain in life except death and taxes. But if he lived today, he would most certainly add inflation to the list. For most developed capitalist economies, inflation is a market force as inevitable as the rising tide. A small amount of inflation is considered healthy and can encourage growth and overall prosperity. But as we've seen over the past year, a sharp increase in the cost of living can have the opposite effect, and its negative impacts are still being felt across the country. What then is a savvy investor to do? How can you ensure that you are still generating wealth even as inflation grows? Well, it starts with understanding the fundamentals of inflation and hedging against its negative impacts. How? By diversifying your portfolio with assets that aren't tied to the financial markets. Inflation is defined as the rate of increase in the prices of goods and services in an economy over a given period of time. Alternatively, inflation can be viewed as a loss of purchasing power of that currency over a defined period. This is why we make adjustments when looking at prices from decades past. Consider the cost of milk. In 2019, the average price of a gallon of milk in the US was $3.45, while in 1950, that same gallon cost just 83 cents. This doesn't mean that milk was any less valuable or of inferior quality in 1950. Rather, the price difference reflects the impact of inflation over time. A single dollar simply went further in 1950 than it does today. Inflation in the US is monitored across a number of different indexes and government agencies. Here are three of the most commonly cited. The Consumer Price Index, or CPI, is the most commonly used measure of inflation. Administered by the Bureau of Labor Statistics, the CPI reflects the cost of living for the average consumer. Household surveys are used to identify a basket of the most frequently purchased items and expenses, and the price of that basket is measured over time. The contents of the basket are kept as constant as possible, but are occasionally adjusted to reflect new long-term trends like the rise of new technologies. In the US, the largest component of the basket is typically housing expenses like your rent or your mortgage. Then we have the Producer Price Index, or PPI. This measures inflation from the producer's side of the market. As its name suggests, it reflects the average prices producers are getting for goods and services. The PPI is calculated by dividing the current prices sellers receive for the same representative baskets of goods as the CPI, and then multiplying it by 100 to get a percentage. The PPI is particularly useful when trying to forecast consumer spending and demand. And now finally looking at personal consumption. The Personal Consumption Expenditures Index, or PCE, is tracked by the Bureau of Economic Analysis. Like the CPI, it measures the goods and services people consume, but it also includes things that they don't directly pay for, like healthcare. The PCE is generally less volatile than the CPI because it excludes things like food and energy expenditures, which tend to fluctuate rapidly and often. So, inflation, friend or foe? Whether inflation is good or bad depends on an individual's circumstances and the rates of price increases. A small amount of consumer price inflation is generally considered to be a good thing. The Federal Reserve, or often called the Fed, is tasked with keeping inflation at a level that encourages spending and investing, which drives economic growth. The Fed typically aims for a 2% increase in PCE per year. When inflation rises faster than wages, however, consumers feel the sting. Lower income households are generally the first to be impacted, as the proportion of their budgets dedicated to the necessities is much higher. Hyperinflation, which means out of control inflation in excess of 50% per month, has destabilized entire nations. Zimbabwe and Venezuela are recent examples of this devastating phenomenon. The root of inflation is the money supply. More money in circulation means that a single unit of currency has less purchasing power and prices are comparatively higher. Yet inflation can occur in many other ways beyond a government simply printing more money. This can also include expanded access to credit, increased demand overall for goods and services, product shortages or decreased supply, also labor shortages, increased costs for raw materials, policy changes regarding government spending or tariffs, and interest rates. But now let's take a step back and look at the current state of inflation. In 2021, inflation made its way into news headlines after hitting the highest level since 1982. Though if we looked at the aforementioned list of inflation causes, the reason for this one's more clear. Manufacturing shutdowns due to COVID-19 crippled parts of the global supply chain, which tripped up many sectors of the economy into product and material shortages. At the same time, government stimulus checks and relief programs bolstered savings, so the expiration of lockdown measures led to a burst of renewed spending. Though wages have seen a sharp increase to compensate for the climbing cost of living, the new year isn't expected to bring relief right away. Inflation is anticipated to be a continued economic challenge throughout 2022. The Omicron variant threatens to exacerbate both labor shortages and existing supply chain troubles in industries from vehicle sales to new home construction. However, as the Fed rolls back pandemic stimulus measures in favor of raising interest rates, this will likely curb the rise in prices. While wage increases can dampen the impact of a cost of living increase, investing responsibly is one of the best ways to hedge against inflation. The term hedging itself actually dates back centuries to when actual hedges were used as fences to contain and protect livestock. In more modern financial parlance, hedging refers to various steps you take to protect the value of your investments. To successfully hedge against inflation, a portfolio is structured so that the rate of return outpaces that of the rate of inflation. Certain types of assets tend to do better than others when it comes to this. Stocks and index funds largely appreciate over time and can do so much faster than the inflation rate. There are no guarantees, however, particularly when the economy is experiencing an extremely volatile period like we're seeing right now. Other avenues include investments like Treasury Inflated Protected Securities, or TIPS. They're special inflated index bonds with interest payments that rise with inflation as measured by the CPI. TIPS pay interest at a fixed rate twice per year and can be purchased through a bank or broker. Real assets are tangible items with intrinsic value, which makes them excellent for hedging against inflation. Although their prices in the short term can be hard to predict, they're generally expected to appreciate over time. Some examples include alternative investments such as gold and other precious metals, natural resources, fine art, vintage cars and other collectibles, real estate, and franchises. Franchising, well, let's talk about that as an investment against hedge. Franchises are a sought-after asset class due to their regular cash returns, low volatility, and FTC regulation. Another bonus is that franchises are inflation and recession resistant. When inflation rises, so do the costs of their goods and services that they sell. This leads to higher profitability and investor distributions. A more profitable business also appreciates faster, providing a long-term hedge against inflation. It's worth noting that for franchises, high yields are not simply a product of an inflationary period. They're a regular feature of the assets. Investors are putting their money into a proven business model that is primed for market entry. Franchises enjoy the benefit of a loyal customer base as well as brand recognition and existing systems in place they've developed over years or even decades. Because of this, it takes less time for a business to become established and begin to generate profits. While most people associate franchising with restaurants and fast food, this business model is actually present in over 100 different industries. In 2020, there were an estimated over 750,000 franchise establishments in the US, covering a huge range of sectors from automotive services to hospitality, staffing and employment, health and beauty services, accounting, financial services, fitness, education, home improvement. The list really goes on. This diversity, along with the ability of the franchise model to scale new technology and adapt quickly for in-demand products and services, makes franchising particularly resilient in times of economic turmoil. As we work toward recovery in the wake of the initial pandemic, franchises also have the potential to create jobs within the communities they immediately serve, and across delivery and supply sectors as well. This makes franchises a relatively stable asset in the long term and presents investors with an opportunity to further diversify their existing portfolio. In short, franchising offers comparable return potential to more high-risk asset classes like venture capital, with more stability using income-generating asset that's typically only found in real estate or dividend-paying stocks. Until now, franchise investing was a method of wealth generation reserved only for those with significant time and capital. New entrants to the space had to overcome potentially insurmountable startup costs and demand for operational expertise. However, with FranShares, anyone can invest in a portfolio of high-yield franchise locations through our fractionalized approach. You may already have some familiarity with fractionalized investing, which allows pools of individuals to invest in expensive assets like vacation homes, private jets, racehorses. In venture capital, the equivalent would be a syndication, which is a special purpose vehicle that allows multiple investors to back a single company. At FranShares, we've taken this method of ownership and applied it to the franchise world. This allows both accredited and non-accredited investors from all walks of life to purchase partial ownership in a portfolio of pre-vetted, managed franchise locations with a high return potential for as little as $500. So how does it all work? Our model takes the power of crowdsourcing and applies it to the franchise investment. FranShares invests in locally operated franchise locations alongside our pool of investors. We then act as the operator for each location and distribute the resulting recurring profits to each investor. In addition, franchise remains a co-owner and stakeholder in our investment portfolios. We assume all management responsibilities for our franchise locations and appoint teams who are experts at creating successful franchise businesses. This allows franchise investors to enjoy returns in their investments while avoiding the stress and responsibility of full franchise ownership. When it comes to the benefits, we combine deep industry expertise with a zero-fee approach that ensures our investors maximize their long-term returns without risking their shirt. Our mission is to help investors reap the benefits of franchise investing with a unique business model that offers passive income. Our best-in-class franchise management team ensures that our investors enjoy truly passive income through quarterly distributions without actually managing the franchise. We do all the legwork, you just sit back and enjoy the returns. We also offer flexible capital commitment. We do this by offering both accredited and non-accredited investors the opportunity to invest for as little as $500, although our model does appeal to ultra-high net worth investors as well. This platform allows everyday investors to become fractional franchise owners with the ability to invest the right amount of capital for their own personal circumstances. Franchises are real assets with little or no correlation to the overall stock market. Thus, they act as a hedge against inflation and they're not subject to the same level of volatility as the stock market. Furthermore, our fractionalized ownership approach allows investors to fully diversify their franchise holdings. You own a portfolio of franchises across different geographies and industries, which creates an effective buffer against challenges that may shut down a single location or franchise. Franchise only invests in recession-resistant franchises with a track record of success to minimize volatility and give our investors peace of mind. We perform all the due diligence and thoroughly vet each franchise partner for strong brand recognition as well as market positioning. Franchise is subject to both Federal Trade Commission and SEC regulation, which requires full disclosure of each franchisor's background, financials, and performance. In addition, we provide investors with reporting and regulatory compliance documentation above and beyond what the regulators require. Traditional investment vehicles charge a 1 or 2% asset under management fee. That can significantly cut into your returns as an investor. But because franchise participates in every fund, we're able to waive all those platform fees and pass along the benefits to our investors. Our profits come from co-investment in franchise locations as well as brokerage commissions from the franchisor, not from the fund. This approach both preserves capital for our investors and creates parity in the investment opportunity. You can, in fact, have the best of both worlds. The value of your franchise investment will increase over time, as well as provide passive income. If you're an investor who wants to hedge your portfolio against inflation by adding franchising, franchise can help you achieve these goals, while also eliminating the drawbacks of the traditional franchise model.